pass the word to our moderator, who will introduce our guests and organize our discussion. I would like to point out briefly that Professor Lazonick is certainly one of the most important economists and academics, who, among other things, has illuminated our understanding of industry, production, and innovation, particularly stressing the impact of financialization in the organization of firms and their strategies of production and innovation. Professor Coutinho is also one of our leading economists, not only in Brazil, but all over the world, having led what arguably have been the most important research activities in the last 40 years in the area of industry, innovation, and public policies in Brazil. And was also the longest serving president of the National Development Bank, BNDES. The theme of our webinar is of key importance to the present understanding of the global economy and is also of vital interest to RedeSist's research agenda and the research agenda of our main partners, particularly the Fundação Oswaldo Cruz. We will certainly have an excellent discussion. Professor Marina, please take the lead.
Thank you very much. Thank you, Cassolato and Elena, for organizing this great initiative for RedeSist. And good afternoon, everybody. It's a great pleasure to be here as moderator of this very interesting webinar and to receive Professor Lazonick and Professor Luciano Coutinho. The title of Professor Lazonick's lecture is How Maximizing Shareholder Value Minimized the Strategic National Stockpile, the $5.3 trillion questions for pandemic preparedness raised by the ventilator fiasco, which is based on his working paper from July 2020 and is co-authored by Matt Hopkins. Professor Lazonick will speak for approximately 40 minutes, and after Professor Luciano Coutinho will make his comments. Then I will open to the questions of the audience that can be done both in the chat or directly with open video and audio. I would like to kindly ask the audience to keep the microphone closed during the lecture of Professor Lazonick and Professor Luciano Coutinho. I will now present our guests. William Lazonick is Professor Emeritus of Economics at the University of Massachusets, is co-founder and president of the Academic Industry Research Network. He is an Open Society Fellow and a Canadian Institute for Advanced Research Fellow. He has professorial affiliations with SOAS, University of London, and Institut Mines Telecom in Paris. Previously, Lazonick was assistant and associate professor of economics at Harvard University, professor of economics at Barnard College of Columbia University, and distinguished research professor at INSEAD in France. Lazonick received a Bachelor of Commerce degree at the University of Toronto, Master of Science in Economics at London School of Economics, and PhD in Economics at Harvard University. He holds honorary doctorates from Uppsala University and University of Ljubljana. His research focuses on the social conditions of innovation and economic development in advanced and emerging economies. His book, Sustainable Prosperity in the New Economy, Business Organization and High-Tech Employment in the United States, won the 2010 Schumpeter Prize. He has twice had the award from Harvard Business School for Best Article of the Year in Business History Review. In 2014, he received the McKinsey Award for Outstanding Article in Harvard Business Review for Profits Without Prosperity, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off. In January 2020, Oxford University Press published his book, co-authored with Jiang Subshin, Predatory Value Extraction, How the Looting of the Business Corporation Become the US Norm and How Sustainable Prosperity Can Be Restored. Professor Luciano Coutinho was born in Recife, in the northeast of Brazil in 1946, and is graduated in economics in the University of São Paulo. Professor Coutinho earned a master and a PhD degree in economics at Cornell University in USA. After returning to Brazil, Luciano Coutinho became a professor of economics at the University of Campinas, Unicamp, Brazil, where he taught, led relevant research projects, and has been the dean of the graduate program in economics. Professor Coutinho has been a visiting professor in the University of Texas, USA in 1980, in the University of Paris 13, France in 1992, and in the Ortega y Gasset Institute in Madrid, Spain in 2005. As a professional economist, Luciano Coutinho has been a founder and leading partner of LCA Consultants, which later became the largest economics consulting company in Brazil. Besides his professional and academic careers, Professor Luciano Coutinho held relevant positions in the public sector as Vice Minister of Science and Technology from 1985 to 1989, and as President of the Brazilian National Development Bank, BNDES, from 2007 to 2016. Currently, Dr. Coutinho is a visiting professor at the Institute of Economics of Unicamp. Professor Coutinho has many published articles and books and has coordinated a landmark research project on the competitiveness of the Brazilian industrial sector in the early 90s, and more recently in 2017-18, co-coordinated the research project commissioned by the Brazilian Confederation of Industry, CNI, about the impact of disruptive innovations on the Brazilian economy. So I will give the word to Professor Lazonick, and you can begin your lecture now. Thank you very much.
Well, thank you. It's great to be here. And I'll try to keep my, stop me if I'm going over, because I'll try to keep it to 40 minutes. Okay, get my talk up here. Okay. Okay, I gave it a slightly shorter title, which is the title of my recently published book, and which came out just before the pandemic. And this is, of course, the research that we're doing now, and I'm doing it with my research organization, is, among other things, been shifted gears in the last several months to 6 months or 7 months to understand what's going on in this totally unexpected plague that's hit us. We knew we had the Trump plague, but we didn't know we had the COVID plague to go with it. Okay, now I'm going to talk in some general terms to set the stage. I'm not going to talk much about the details of the particular study we did in that paper, because it's illustrative of the main points we want to make. But first of all, just the way I approach looking at the economy and at what actors are doing in the economy. Are they or not contributing to what I call sustainable prosperity, equitable and stable economic growth? And probably the objectives that were set out here, we want growth that's stable employment, equitable distribution of income, including sharing of the natural resources over time and across generations. Probably a lot of economists will agree with that. I'm not sure, but I think most economists might. They probably disagree with almost everything else I have to say about, except maybe the people who are on here and other select few, about how we achieve sustainable prosperity. Now, we know that in the United States, we don't have that. This is a graph from the New York Times using Piketty and Say's data, where they look by percentiles. It's a little unclear, but it's the income percentiles from lowest to highest on the horizontal axis. And that gray line shows 1946 to 1980, and the change in income by percentile. And you can see the lowest percentiles got the most change in income. And that was totally reversed from 1980 to 2014, a 34-year period, where almost all the gains were concentrated at the top, and certainly the lowest got hardly anything. This is another kind of macro indicator that's been put together for a long time by Economic Policy Institute, which shows that around the early 1980s, there was this growing gap between wage growth and productivity growth in the economy as a whole. And I like to say that in that gap is kind of the place where the predators play. So you have to say who is grabbing those gains. This is a third way of looking at it. It's the Gini coefficient. And like those other indicators, we see major changes that occur from the late 70s, early 80s, and then just keep taking off, more and more inequality. And my view is that what is driving this fundamentally is that we rely on corporations not only to generate productivity growth, but also to provide stable employment and also to provide a somewhat equitable distribution of income. And sometimes they do. And I would argue that when capitalism is working well, corporations are contributing to a more equitable distribution of income, at least among the people that they employ, rather than undermining it. But that has not been the case. And it's been corporate resource allocation regime that stresses shareholder value, which is a theory of value creation, which is not that is actually put forth that way as it's a theory of value extraction, I call predatory value extraction, that's been driving this. And what I mean by predatory value extraction is that there are some interests who are able to have the power to take money out of companies that is far in excess of any contribution they make. So we always have value creation, value extraction. You contribute your productivity, you get your wages, but that has not been what's going on. And so we have this book that I wrote with Jiang Sip-Shin, who's an economics professor in Singapore, from Korea originally, and where we go through this process and using what I call the theory of innovative enterprise, which I'm sure many of you are familiar with, so I'll present extremely briefly, to look at this predatory value extraction. And as I said, this came out, we've been working on it for some time. It came out just before the pandemic, or as it was breaking, but of course it's finished long before that. And basically we had this problem of the looting of the business corporation had become the norm. And frankly, I think that's one of the reasons why you could get someone like Donald Trump elected in the first place. We'll go into that in great detail, but I won't. And of course, now what we're seeing in the United States is criminality in plain sight all over the place. An inability of the legal system to do anything of it, partly because the legal system has been captured, and everybody hoping something good happens or reasonably good happens with the election on November 3rd. We'll see. But we still have this phenomenon of maximizing shareholder value, predatory value extraction, that coming into the pandemic, and it has made things worse, not better. Okay, now to understand how you extract value, you have to understand how you create value. And I think this is one of the reasons why most economists cannot deal with the kinds of things I'm arguing, because they just do not understand how productivity is generated in the economy. And so I started using this notion of an investment triad, the different organizations, and a household is an organization, a government agencies or organization, business firms or organization, how they act as supportive family, developmental states, innovative enterprise, to work together. So there's a notion of a triad to generate productive capabilities that can result in higher quality, lower cost products, which are what drive innovation, the growth of the economy. And that's really what innovation is all about. From this perspective, the functioning markets, when you can buy lots of goods, when you can change jobs relatively easily, when you can borrow money, that's a result of the success of the investment triad, and particularly we depend on business firms to ultimately deliver those products to us, deliver most of the jobs to us. About 80% of the jobs in the United States are from the business sector. And actually a lot of the financial markets have to do with not all of them, of course, but with business securities. Okay, the state is extremely important here. And what we started doing in this paper is talking about government business collaborations. People often use the term public-private partnerships, but I stay away from the term private, because if you refer to business corporations as private enterprise, it's ideological and it's a misnomer, because most business corporations, and I'll show you some examples later, there's been a separation of ownership control in some cases for 100, 150 years in some corporations. And the notion that they're private is something that is often used to say, well, they can do what they want, but they're not private. And even if they're privately held, they still are getting a lot of privileges, a lot of benefits from being in a particular environment, including government investment, which is routine in knowledge and infrastructure. And I could give a whole lecture on the U.S. developmental state, because I guarantee it's the most developmental in history. We don't have the Bindes, but we have a long history of government on virtually every technology is important, every sector is important, having made huge investments when they're too early, too costly, too uncertain for business to undertake. The internet, for example, is one example. And here we can see also another example. Probably wouldn't have a global pharmaceutical industry without the National Institutes of Health. The funding, this measures it from when it's first recorded in 1938, over 1.2 trillion in 2019 dollars, an annual budget of almost 42 billion now. And at the same time, here is where we see the problem of government making all this investment, but financialization. So we've been updating these data over time. We take the companies, the pharma companies in the S&P 500, who often argue that they need high drug prices, which are unregulated in the United States, because this allows them to use their profits to reinvest in innovation, which is in and of itself is a potentially valid argument, because I argue that reinvested profits is the foundation of growth, of investment in innovation. But they don't use it that way. They use it to prop up their stock price through stock buybacks on top of dividends. And so we have the data here, which show that, in fact, they're spending combined over 10 years, these companies, about 14% more on buybacks and dividends than they are on R&D. So there goes the argument that they need high drug prices. Meanwhile, they get patents, they get all kinds of privileges, subsidies from the state, and as well as access to all this investment research. That's obviously of great importance in the COVID-19 crisis, because there's a search for a vaccine. We're doing quite a bit of work on regulation of drug pricing on this whole area of pharma. At some point, we'll have a certain amount to say about the vaccine development process. We're following it, but we're not writing an explicit paper on that, because there's some more general principles we're trying to get out there about pricing. But basically, we see these government business collaborations as critical to prepare for and then respond to pathogen pandemics, climate change, as well as economic injustice, income inequality. And that when all of a sudden you realize that there's a problem, it's too late if you haven't prepared for that problem. And it's left to government really to take the lead on this, but it needs to have the cooperation of business, and it can't just ask for the cooperation of business when the disaster happens. There need to be collaborations, far-reaching collaborations, in order to be prepared for these kind of existential crises. Okay, and our basic argument is that if you have companies that are making what is really a nonsensical argument, that the best way to run those companies is to maximize shareholder value, and I'll explain briefly why it's nonsensical fiscal in a few minutes, then you're not going to have reliable partners in these government business collaborations. Now, these are data on the size of firms. These are employees in the U.S. collected by the census. And basically, if you just look at the line that says 5,000 plus employees, you see that there's 2,156 companies, which are a tiny percent of all the companies in the United States, the business firms. But they employ almost 21,000 employees per company, so it's about 45 million people. They account for 35% of the business sector employment, 40% of the payrolls, and about 6% of the revenue. So what those companies do or do not do in terms of the allocation of resources and in terms of reinvesting profits, because you don't grow to be that size unless you have a long track record of profitability and reinvesting, what they do is a problem. And if at some point you have an ideology that comes along and says, oh, all those profits don't belong to workers who work there, don't belong to the government to help fund these investments. They belong to a group of people, shareholders call them, and who can extract as much as they want because they're the ones that make the economy work. Well, then you're going to have a problem. And that's what I've been studying for some time, really, since the 1980s, since I witnessed the problem arise when I was at Harvard Business School and they hired a guy named Michael Jensen. And so we have a framework where we talk about going from companies retaining money and people and reinvesting in productive capabilities to the other extreme of downsizing the labor force, selling off assets, taking on debt, distributing cash to shareholders. And in between, there's an important category because we have many dominant companies in the economy, companies, and I'll give the examples later of Apple and Microsoft, which we have in the paper, that dominate and distribute. That is, they have a certain lock on or large market share and a sustainable market share, at least for the time being, and maybe for a decade or two in a particular part of the economy. They keep generating profits. They distribute it. They might not be downsizing, but they actually, by playing that role, by distributing massive amounts of profits, and not just in dividends, which are not the bigger part of the problem, but in stock buybacks, they create pressure on everybody else, all other companies in the economy, at least listed on the markets, to get their stock prices up. And many companies can't afford to do that and go to the wall trying to do that. Okay, now, this is in a context also historically of a massive change in the business model that occurred in the United States. So we can characterize, of course, not true of every firm in both times, but these periods post-World War II, when you had a trend toward somewhat more equality as a period of retain and reinvest. And in fact, companies had the norm of a career with one company. You just did not lay people off. That happened to be a white man's world when that was dominant. And I think that has something to do with it. We've had the rise of the new economy business model, which in many ways entails innovation. Companies like Apple, companies like Intel, Microsoft, Alphabet, Cisco, but they actually were building on a lot of the investments that have been made in the old economy business model, not only by government agencies, but also by the corporate research labs of business firms. And part of that process of change was jobs became insecure. There was a focus on the stock price, not initially because of predatory value extraction, but because they had to attract both money and people away from the old economy. So you had the rise of venture capital, which through an exit on the stock market, and which they could do once they created NASDAQ in 1971, was induced to invest in startups because of the ease of exiting on the stock market and attracting people from the secure employment in the old economy companies to what often people chose to take was insecure employment, particularly if they were white collar workers, software programmers, et cetera, in the new economy, induced to come by stock options, stock-based pay. But we've had a lot of developments since that started to occur in the 1970s and 1980s, which have, and I'll only get a little bit of it here, It's much more in the book that with Jiang Sup on how this led to this predatory value extraction, this looting. Now, if you want to put a face on these two eras here, or two faces, the one on the left, Edith Penrose, who really understood what was going on with the business model, at least in terms of capabilities, reinvestment, in her book, The Theory of the Growth of the Firm, published in 1959, very consistent with the work of Alfred Chandler in his book, Strategy and Structure. It came out in 1962. They were kind of actually at the same universities at one point, Johns Hopkins, but at different times, but didn't really know each other too much later. Then you have on the right, Michael Jensen, who is the guru for maximizing shareholder value. And I was at Harvard Business School in 1985 when he was hired, and coming out of economics and being critical of economics, I said, this is the beginning of the end, because it gave him a bully pulpit to, and he immediately capitalized on that at Harvard Business School to popularize the notion of maximizing shareholder value. It's another story that in 1992, when I gave a paper at Harvard Business School in a seminar, business history seminar, criticizing him, he got me banned from Harvard Business School. They invited me back about 17 years later. This is a paper that came out, I posted on INET website last January, which basically, if you're interested, just shows that what PhD economists have been teaching students and been thinking themselves for at least 7 decades, is that the most unproductive firm is the foundation of the most efficient economy. I won't go into that other than to say that if you start from that perspective, you're never going to understand how you achieve sustainable prosperity, stable and equitable growth. And in fact, you're going to have a predilection to see that whenever there's a problem in a firm, that the problem is going to be solved by taking the money out of the firm and putting it out somewhere else in the economy. Actually, the function of making the firm so insignificant in neoclassical economics, it says the market should do everything and the firm should do nothing. And the liberal, or the, in the American sense, liberal, East Coast liberal Paul Samuelson is implicated in that, as is the Chicago School, Milton Friedman. Now, if you have a theory of innovative enterprise, you can start to understand how, in fact, the economy is not necessarily a zero-sum game, how all participants in the economy can gain, as I lay out here. Okay, how is this done? Basically, it's by reinvesting in products and people, and in a process that's uncertain, collective, and cumulative, and because it's uncertain, collective, and cumulative, the firm needs a strategy, it needs organization, and it needs finance. And then there are these, what I call the social conditions of innovation enterprise, which says that it really matters who is exercising strategic control, what their incentives and ability are, because they have to confront uncertainty, how you integrate people into an organization, how you get collective learning, and the extent to which a company invests in collective learning in order to try to generate a competitive product in this industry, and how you commit finance to the process. So till you get financial returns. And that's one of the reasons why, or the reason why, retained earnings, once you can get profits, are precious and need to be reinvested, because they're controlled by the firm, by the people who exercise strategic control. They can be used to support collective learning, cumulative learning. Okay, what you want to get is a higher quality, lower cost product. Basically, if you're successful in the learning process, you can generate a higher quality product, then that will help you access a large extent of the market, and you can get economies of scale. So what you want is, in fact, what you see on the right-hand side here of a cost curve that's getting economies of scale. And that, of course, totally disrupts the way economists like to think about optimizing behavior, et cetera. But that is what you have to understand. And nobody who says that they're going to innovate can tell you at the outset that they're actually going to achieve the higher quality product, which gives you actually the high fixed costs that can put you at competitive disadvantage, but that they'll be successful. And if they are, that they can get economies of scale, get the low unit cost. That's something that firms have to do. And that's what innovative firms do. And we have to study how in fact they do that. So there's a lot of implications that come out of that. The critical labor is really is not going to get you sustainable prosperity if labor is a variable cost, as most economists assume. It has to be a fixed cost to the firm, although it's one that can't go on the balance sheet because you can't own people. Organizational learning is accumulated assets, and even then, of course, we most places categorize R&D as a current expense. Of course, it's an investment. Net present value calculations are really garbage when you're talking about innovation, and some people like Clay Christensen have argued that they're innovation killers. And one of the stupidest theorems that ever put forth by economists, Modigliani Miller, which led to this end debate about equity and debt and taxes and all this stuff. It makes a huge difference to a company whether it has money that it controls or money to which it owes to other parties and has to pay principal and interest and be put into bankruptcy. And debt comes on top of equity when you are going to get a retain and reinvest regime. We published an article, a shorter article in Harvard Business Review last January on how, in fact, debt has been used to do buybacks. So you're doing just the opposite. You're giving away the money and taking off debt while you are eschewing investment in productive capabilities. The term even capital flows is an oxymoron. It's finance that flows. Capital is invested in an asset. Now, it's right now, a couple of days ago, 4 days ago, was the anniversary of this stupid article written by Milton Friedman in the New York Times Magazine. And for a long time, I thought it was just, I don't know if people are aware of it, but the social responsibility of business increases profits. It's seen as the article that kicked off the shareholder value movement. I was always critical of it because knowing Milton Friedman's work, I knew he knew nothing about how a business organization ran. And of course, he adheres to this notion like Samuelson did of the unproductive firm being the foundation of the most efficient economy. But there was a bigger problem, and that you start seeing that problem when you see the actual way it appeared in the New York Times. That's the chairman of General Motors, and he's talking to a group of people who are also pictured, I don't show them, who are part of Campaign GM, inspired by Ralph Nader, consumer movement. He wrote Unsafe at Any Speed, which was in large part about General Motors cars in 1965. And the Campaign GM wanted to put 3 public interest people on the board of directors of General Motors in order to deal with safety of cars and pollution and environmental issues. And so that was in May. This picture of the chairman there is in May of 1970. And the voters overwhelmingly defeated that proposal. But then in August, they set up a committee of existing board members to study this proposal. And that was too much for Friedman and probably for some, we don't know who it was, some editor in the New York Times who solicited the article, called it a Friedman doctrine. And here's basically that box of writing you can't read there is editorializing by the editor, who says that they've demanded 3 new directors to represent the public interest, and then they set up this committee to look at the performance of safety and pollution. The stockholders defeated the proposals, but management put 5 directors on the public policy committee. It was that move that Friedman calls such drive for social responsibility pure and unadulterated socialism. And he said the businessmen who talk this way are winning puppets of the intellectual forces that are undermining the basis of a free society. Now, for any of us who have our eyes open, we know what's happened since then, that General Motors has lost substantial market share, has become really almost second-rate companies, Japanese companies, and now even to potentially to Chinese companies, certainly the Korean companies, the German companies, because it didn't deal with safety and pollution and fuel efficiency. And so basically what the people at the public interest people wanted, you call it corporate responsibility, but it's the future of innovation in the auto industry. And so what Milton Friedman using this nonsense of pure and unadulterated socialism, was arguing against. He was telling the U.S. corporations and U.S. corporation General Motors, don't invest in the future of the automobile industry. Don't invest in innovation. And of course, once, in fact, households decide that they want safer cars, they want more fuel-efficient cars, General Motors had a problem. So that's the nonsense that was out there, but it was very influential nonsense. Now, this guy, Michael Jensen, turned it into, gave it much more, let's say, rigor, if you want to call it that. 1976 theory of the growth of the firm, theory of the firm, not the growth of the firm, theory of the firm is one of the most widely cited articles in economics, maybe in academia. And here you see there's an article, useful article about Jensen, the growth of citations of that work. It really caught on started to advance in the 80s and took off in the 90s and beyond when this theory dominated. Now it's rooted in the notion of this unproductive firm is the most foundation, most efficient economy. So the market, the firm is a market imperfection. It reflects inefficient financial markets that aren't allocating their resources to the best alternative uses. The notion is that the firm is a nexus of contract. Everybody's getting a market-determined, guaranteed yield on whatever they're supplying, whether it's labor or it's a product or debt. But the shareholders bear risk of making investments without guaranteed returns. And then there's an assumption that risk-bearing function makes for a more efficient economy. They have absolutely no theory about why that's the case. But they make that argument to say that those who bear risk should control the allocation of the economy's resources. And that shows up in this 1986 article of Jensen's, which he wrote just after he came to Harvard Business School, in which he talked about the free cash, disgorge the free cash flow, take the money out of companies and put it somewhere else and overcome, vest it where it's more productive and take it away from where it's less efficient. Okay, the problem, even the term disgorge is a term which says somehow this money shouldn't be there. It was there because the company was innovative in the past and people working in that company, often who had, up to that point at least, career with one company, were contributing to those profits. To call the free cash flow free, that free is a very ideological term because it immediately became apparent to me in the late 80s that meant if a company could lay off 50 people who had worked there for 20 to 30, 5,000 people who worked there for 20, 30 years, lots of cash flow was free. And that's exactly what people like Jensen were arguing for. And then they said, incentivize executives to disgorge this free cash flow by giving them stock-based pay, which is exactly what they did. Okay, the flaws in the argument are workers and taxpayers take risk all the time. If I go to work for a company, I care about whether I'm going to be employed there in the future. And if I don't care, then I'm not going to contribute to their collective and cumulative learning. They want me to care, and I don't have a guarantee that I'm going to get that job in the future, however. When I, as a taxpayer, contribute to, let's say, the funding of the NIH, if those companies are not successful that use it, I'm taking a risk that we're going to fund all these drug companies. And in fact, there's not going to be profits that can be taxed that give us a repayment. But there's also the political risk that they're going to argue that they need lower taxes in order to make more investments, which of course is part of the corollary really of maximizing shareholder value. Workers face the same political risk. You have the money, then someone says, let's change the rules of the game and be able to lay you off. The irony in all that is that, at least in the United States, historically, the stock market is not a source of funding of companies. It's a way of taking money out of companies is separating ownership and control. And what stock buybacks do is just not only disgorge the cash, but so-called, but it also props up stock prices, allow people to cash in on them. Okay, so it's the opposite of retain and reinvest, and it results in downsize and distribute. And then the work we've done found that all kinds of other things like avoiding taxes, laying off workers, offshoring, price gouging, environmental pollution, whatever, is a corollary of seeing the role of the firm of getting the profits up, downsizing the labor force, distributing the profits to shareholders. And that's back to the point that this is why these firms are unreliable if you want to deal with, for example, a pandemic. The in between downsize and distribute, we call something which I mentioned, dominate and distribute, of some companies that can distribute lots of money for a long period of time and without necessarily downsizing, although they put pressure on downsizing. Here we have data on this distribution to shareholders, the same 222 companies over 38 years. And you can see that here that at the beginning, buybacks were minimal in 81, 83, and then they're on top of dividends even higher as a percentage of profits. And this is in a period of high profitability. So these are really high numbers in 2016, 2018. These are the largest repurchasers. And you can see Apple there way in the lead, followed by Oracle, Microsoft. I could go on for hours and hours talking about these particular companies and how it's screwing up innovation and leading to unstable employment and inequitable income and sagging productivity growth. But it's massive. Here is a picture that shows when this emphasis or explicit emphasis on shareholder value kicked in. And it really was right after. It had a lot to do, and I was kind of there when it happened, as I say, when Jensen was hired, after Harvard Business School put its stamp of approval on his on shareholder value ideology. Of course, Harvard Business Review publishing my article now 6 years ago, was something of a departure from that. This is from another article, the one I showed you before. This is, and you can see actually in the Wall Street Journal, it takes off earlier. Interestingly enough, the New York Times doesn't pay as much attention to it, but the Financial Times, it really takes off, and it sort of spreads to the UK much more in the 1990s. Okay, this is why you can do it. This was the Securities and Exchange Commission is supposed to regulate manipulation and fraud in the market. It was captured by the Reagan Revolution and by this guy from Wall Street, John Shad, in Chicago School. And they said you can manipulate the market. You can do up to 25% of the average trading volume over the previous 4 weeks at any single trading day, day after day of day, without being charged with manipulation. In fact, there's a safe harbor, which means that even if you go over the 25%, you're not necessarily manipulating the market. And the companies don't have to disclose how much they're doing on any day, so they've never been charged with manipulation. We don't know to what extent they've been manipulating the market, even at that level. But just to look at the last column here, which is the most recent calculation I did, Apple can do $5.7 billion per day, trading day after trading day, without being charged with manipulating the market. Now, it's in a special category there because of its price and volume, but Microsoft's up there at 1.8 billion, and 300 million a day after day every day. That's a nice way to boost your stock price. The beneficiaries of buybacks, which are this is open market repurchases, are people who are timing the buying and selling of shares, which include top executives and hedge fund managers. So in the book, Predatory Value Extraction, we have a framework of looking at the insiders, the executives, the enablers, the institutional investors, and the outsiders who are now very powerful. The hedge fund activists used to be called corporate raiders, who are involved in this predatory value extraction. Here's just some data on the stock-based pay of executives that incentivizes them to do this. You now have more and more concentration of shareholding in pension funds. In fact, a lot of it is just exchange-traded funds, which are people buying shares in the index, and which is taking over more and more of the market. But all those pension funds, because of changes permitted by the Securities and Exchange Commission, not only have votes, the proxy votes of the shares they hold, they have to vote those shares. And that's given them, the hedge fund activists and the underlying people here are the ones who go into companies and rip them apart, the power to have 1% of the shares of a company like General Electric and get enough proxy votes or threat of proxy votes, even without a proxy fight, to really run that company and decide who's going to be the executive and kick people out. And these people pull in massive amounts of money when they're, not all the time, but when they're successful at doing this. So maximizing shareholder value undermines innovation and undermines strategic control because the people running the company are no longer focused on investment in innovation. It undermines organizational integration because you often just let go of the people who you need to have to innovate, and it takes away the sources of financial commitment. Okay, so we started looking at this when the pandemic hit and wrote some articles on this. And the particular study that Matt Hopkins and I did was looking at ventilators, which is actually the most tractable of all the things they have, the countermeasures they have in the Strategic National Stockpile, which is a kind of a stockpile of these countermeasures set up in the right after the U.S. set up the Department of Homeland Security and around getting the U.S. into the Iraq War, and they set up out of that the Biomedical Research and Development Authority (BARDA), which entered into 2 contracts with innovative ventilator firms under the Obama administration, 2010-2014, that actually are good government business collaborations because they weren't just wanting to get these ventilators in the stockpile. They wanted to induce innovation in ventilators, get more portable, usable, cheaper ventilators that would be high quality. Because when they're in the stockpile, it's like an insurance policy. You hope you never have to use them, but they cost a lot of money. And so they tried with one firm. It was taken over by a firm which is highly financialized, actually a tax dodging firm that had its headquarters already in Ireland. It killed the project. They then made another contract with Philips Respironics, a Dutch firm, in 2014. But Respironics was actually a very innovative manufacturing firm that had been bought by Philips in 2008. And Matt Hopkins is now doing, with the founder and the person who ran Respironics from 1971 to 2008, he's doing a business history of how that firm became highly innovative. But in the hands, they did actually come up with a product that was approved a year ago by the Food and Drug Administration of the United States, a ventilator that is their contract to deliver 10,000 of them at $3,280. They haven't delivered any of them, but the Trump administration has been buying ventilators from them at 5 times the price. So Matt and I, since we wrote the article, has come out, and we're trying to get around to writing an article, which is, I think we might call the art of the double deal, because basically taxpayers paid for the original contract. They didn't get delivered, and then we end up buying ventilators at 5 times the price. The U.S. Congress has seen into this and actually forced the Democrats have forced the cancellation of the contract, but it is a fiasco. And what it shows is that you can't rely on financialized firms. The government agencies pre-Trump were actually doing the right thing here. They don't always do the right thing, but they were in this case. Now, we then turn to, and this is where I'll get toward the end of what I'm going to have to say, to the big looters, because basically you have either people who are explicitly part of the problem or who are part of the problem while they pretend they're not part of the problem. So the third largest repurchaser in the period, this is now 2009, 2018, it would have been Apple, ExxonMobil, and Microsoft. Now Oracle has come in there, which is a particularly greedy firm, and ExxonMobil has moved down in the latest data. But basically, Microsoft, the third largest looter in corporate history, and they say that they're doing this to return cash to shareholders. Shareholders, the only time they ever get money from shareholders was $59 million in its initial public offering in March 1986. So it's nonsense that they're spending hundreds and hundreds of billions of dollars, returning cash to shareholders. Now, meanwhile, Bill Gates, of course, you all know, was the founder. He just actually formally left the company in March of this year, but he was there this whole time. Meanwhile, he has this other face through his foundation, arguing that we need to be prepared for a pandemic. He gave a TED talk in 2015, which, when the pandemic came, everybody was looking at. No need to panic. If we start now, we can be ready for the next epidemic. Well, Microsoft was not doing that. They were just buying back their stock. And they should have, even from an innovative point of view, been involved in business-government collaborations to use their capabilities to help us prepare for a pandemic. Not his foundation, but the company. Instead, they just did buybacks and said, since he gave his TED talk, Microsoft has done 95 billion in buybacks. They could have used that money with a leader like that who supposedly understands what you need to do to be prepared for a pandemic, to say at the business level, we gotta walk the walk here. And that's not what he did. So what we do in the paper, we ask Bill Gates, well, why are you doing all this buybacks? I haven't heard from them. Okay, ExxonMobil, we didn't expect better from them. They became a downsize and distribute company maybe 2 decades ago, if not before, under this guy, Rex Tillerson, who became the CEO in 2006. It was nothing but downsize and distribute. Oil prices were high. They were doing about 22 billion in buybacks a year. Now they're not doing them because they're actually can't even pay their dividend. They're taking losses. Tillerson, meanwhile, left from downsize and distribute in ExxonMobil to become the Secretary of State in the Trump administration, where he proceeded to downsize the State Department. His only saving grace in all that is he was recorded off the record, but it was publicized that he called Trump a fucking moron at some point, but that kind of got him fired. But anyway, there he was, and that's what that company did. Apple is a particularly egregious case because they've gone crazy with buybacks. They call it a capital return program. The same thing is for Microsoft. They got 97 million in their IPO in 1980. That's the last time they ever went to the market to get cash. So how can they return capital to anybody? And it's not capital, it's just finance. And it's hedge fund activists are going after it. Now it's Warren Buffett, one of the largest shareholder, and he's on record as saying he loves it when Apple does buybacks, because without spending a dime, his share of Apple goes from 5 to 7%. And Warren Buffett actually has about doubled his money, 36 billion in Apple. He put in 2016, 2018. It's worth at least double that now without spending a dime. And that's how you get inequality. He hasn't sold the shares. He sold some of them, but not most of them. But nevertheless, he's cheerleading buybacks. Okay. Why does Apple do buybacks? Well, actually, I wrote an open letter to Tim Cook about this in 2014 on the Harvard Business Review website. I haven't heard back from him yet. But if you look at their small board of directors, again, you get this hypocritical behavior. The longest tenured director is a guy named Arthur Levinson. He was the CEO and the chairman of Genentech, which is now, since the late 90s, 100% owned by, or since mid 2000, I should say, 100% owned by Roche. The Swiss company had been majority owned since 1990. It's an American company, but was protected from the stock market, and as a result has been an innovative company, and he is a career scientist there. But here he's sitting on the board with he's one of 7 people, including Tim Cook, and the longest serving member, and you don't hear anything about him as saying, why are we doing all these buybacks when Apple could be using its software capabilities, not necessarily in the same firm, but people and money, to engage in innovation that does people some good and will give Apple actually sources of new innovative capability. The second longest serving member is Al Gore, famous for an inconvenient truth. So we say to Al Gore, the inconvenient truth is you're sitting there. Well, since 2013, Apple has done 360 billion in buybacks, and you say nothing. And this money could have been used to combat climate change, never mind economic inequality. What do you have to say to that? We haven't had any responses. Okay, meanwhile, just over a year ago, the Business Roundtable, which in 1997 had embraced shareholder primacy as the goal of companies, and that then was taken to OECD, which did that in 1999. They backed off from that. They came up with a stakeholder statement of purpose of the corporation. Basically, it's totally cynical. They were afraid that Elizabeth Warren might become the Democratic presidential candidate and then the president, and they wanted to co-opt her. She has something called the Accountable Capitalism Act, which I provided some comments on, and that's why they did that. Their members who signed that have not in any way, we're actually doing research on this, but adhered to this notion that there's a stakeholder purpose of the company. And we looked just at Apple. Tim Cook was a signatory, the CEO of Apple. Since he signed that, they've done 55.2 billion in buybacks, 124% of their net income. That's in 9 months, along with dividends. Now, in the wake of the Black Lives Matter movement, in June, Apple came up with $100 million for a racial equity and justice initiative. But they did that, of course, in the midst of a pandemic with the Black Lives Matter movement in full power. But that we point out that money was only 0.18% of what they had spent on buybacks in the previous 9 months. Never mind what they had, the 0.03 what they spent since 2013. So it's money, but it's nothing for that company. That company should have been doing that all along. Okay. Meanwhile, I'll just end here with a couple of comments on the Black Lives Matter movement, because buybacks have fed into this. A very important leader of the Black movement in the United States, movement for economic justice, is Reverend William Barber. You can find him on YouTube and other places. He's extremely intelligent, eloquent. Back about 5 years ago, he started talking about buybacks when they were trying to organize McDonald's and the Service Employees International Union, which one of the first unions to take up buybacks as something the company shouldn't do. Actually had us write something for them, and he took this up. And I have a book that is, there's 2 chapters on the website of the Institute for New Economic Thinking on what's happened to Black employment over the last 50 years. And basically our argument is that in the 60s and 70s, with the demand for blue-collar unionized labor and equal employment opportunity legislation, there was emerging a high school educated blue-collar middle class that was, if it could have gone on, their children would have gone on to white-collar, college-educated middle class. It didn't happen because that Black middle class was decimated in the 1980s. It was changes in employment and competition that was occurring in the United States, but fundamentally it was corporate financialization, which meant that companies and the government didn't do anything about it. Never mind Reagan, but the Clinton administration, or even later on the Obama administration, have not dealt with the problem because that is not their business. And the government, of course, the politicians are funded by executives of companies who say that this stuff is not their business, just getting their profits up, keeping the stock market booming is their business. So we have a big problem of dealing with these issues if we don't create employment. And it's not just for Blacks, it's for high school educated whites are downwardly mobile, they're dying earlier, but Blacks were first and more hard hit, and there's more, of course, the systemic racism against them. And so we have, again, you can look at those articles and some shorter articles on this. And I'll just end up with these 2 pictures of the Black Lives Matter movement. So those happen to be my 2 grandsons, Malik and Marcus, and unfortunately their father, his best friend, whose name is Yuri Stamps, is his father, who's pictured there, was shot by police in his home in 2011, innocently, and it was swept under the rug. And this is in August. They, with a group of people, my daughter and her husband and other people, have, in the context of the Black Lives Matter movement, have resurrected his case. And so this is at one of the demonstrations they are showing them. And here's another one that was actually in the Boston Globe. Malik Harding 7, that's my grandson, and his father, who's, you only can see the t-shirt, and my daughter, who designed the t-shirt and the banner. You can see her eyes over her mask. But anyway, so everybody's involved here. There's lots going on. The country is a mess, but I think that shareholder value is a big part of why it's a mess. Thanks.
Thank you very much, Professor Lazonick, for your interesting and disturbing lecture. I'm sure you raised many questions and many important points that probably will be raised by the audience after Professor Luciano Coutinho comments that I will pass the word for Professor Luciano Coutinho, then he can do his comments on your lecture. Thank you.
Okay. First, let me thank the organizers and also say to Professor Lazonick that it was a pleasure to hear his exposition. Very provocative, very thoughtful, and for me particularly very interesting, because I had a very convergent views with your own. I mean, I've read Penrose, I've read Chandler, Schumpeter, so my own intellectual route was quite similar to yours. So I enjoyed very much I don't have any major disagreements. So any disagreements from your perspective. I will, however, add another perspective to the same historical process. I mean, you gave a very bright understanding of the microeconomics of the large corporations. But I think we need to tackle the same process from the macroeconomic perspective. So I will utilize the same periodization that you utilized. So we had a period from the post-war to you put the 1973 as a dividing line. In fact, was the formal end of the Bretton Woods systems, in which the dollar was delinked to the gold, and then from 1973 onwards, we created a floating currency. The global currency became a floating currency. And also we moved towards deregulating the whole system. So we had, under the Bretton Woods systems, capital controls of the banking systems. The whole banking activity was under control. Finance was meant to support the development of the productive sector. Interest rates were low. Long-term credits were available. And we had the so-called Fordist cycle, in which the creation of employment and the improvement in income distribution, etc. That was a precious and exceptional period in the history of capitalism. Now, it's more an exception rather than a rule. But we had, after that, the deregulation, and not just deregulation imposed to almost all economies, but global deregulation. It started with the dollar becoming a floating currency, and it started with the big expansion of banks and the liberation of banks from all controls. Banks became transnational banks gradually, and the development of the euro-dollar market created an absolutely unregulated credit space that started to fuel credit to speculation. A very few national states were capable of shielding themselves from these. In Asia, maybe. I would say maybe that China today is the only nation state that resembles the capitalism of the of the 50s and 60s. It may not, of course, it started to deregulate also. But in this deregulation, in the 70s, second half of the 70s, in the 80s and the 90s, up to the big financial crisis of 2006, 7, and 8, the big bubble, these financial deregulation captured the central banks, and the dominance of accumulation of wealth, not of means of production, not of manufacturing capabilities, but the pumping up the value of wealth per se. That's in the very nature of capitalism. That's book 3 of Karl Marx. It's money yielding money in the limit. So that's Hyman Minsk's money manager capitalism, which is also, so we had this big bubble. Result of this capitalism was the big financial crisis of 2000 that developed from 2006, 7, and finally exploded in 2008 with the failure of the Lehman Brothers Bank. But after that, the response to the crisis was a response from central banks, mostly, and also from government spending, but mostly from central banks engaging in quantitative easing. And that created, and of course, the buybacks were already a practice, but the quantitative easing made the buybacks an irresistible business, because you could fund yourself at zero, almost zero interest rates, to buy back your own and to artificially inflate the value of your company. So these, of course, the quantitative easing was meant also to avoid a systemic failure of the whole banking and financial systems. So to some extent it was needed, but the way it was done created more distortions. And in fact, gone to an extreme in which the fictitious nature of financial capital became absolutely evident. So a company may be downsizing, but its market value is going up. So it has nothing to do, the reality of manufacturing, of production, of innovation has nothing to do with the market value. So it's a fictitious form of artificially creating artificial value to extract. The problem is that given the liquidity, you can take advantage, owners can take advantage of these practices to extract this artificial, this fictitious value and convert it into liquid value. So I think that's your reading is very close to other readings of the development of capitalism, and I would say that just a side comment. Why the big? I think this process of quantitative easing, it helped the banks to avoid failure and helped them to deleverage. It helped the whole strata of owners of wealth to save their own wealth, because the main purpose of the quantitative easing was a big buyback by the central bank of private bonds, private wealth was being, the prices of these bonds were being sustained, not just by the capitalists themselves, but by the central bank. So this is the picture of capital, of financial capitalism that we live. On the other hand, you mentioned the big IT services companies, the big five. Google, Apple, Facebook, Amazon, etc. Those, they had a different situation. That's just a side comment. They cannot downsize because the nature of their business is based on the winner-takes-all network, economies of scale principle. They became oligopolists or monopolists because the larger the network they dominate, the more profitable they are. So if they downsize, they lose value. So it's for them, it's a different story. It's difficult for me to envisage them to going into this, but this is a side comment. Let me also add that in the post-pandemic, what we've seen was a reversal of policies when central banks were tapering off, were trying to change into positive interest rate policies. They had to reverse, and the reaction to the pandemics has two sides. One side is fiscal policy that may have some impact on real lives. And the other side of the pandemic was a super very quick return to quantitative easing. And also, that is quite clear how fast the stock market has recovered. Different from the first global crisis, in which the recovery was slow. This time, the recovery was in 3-4 months, in sharp contrast and absolutely disconnected with the fact that unutilized capacity in manufacturing, unemployment are still very high. So in the real world, the economy is in a recession. People lost their jobs, lost income. And on the other hand, this same process is pumping up the price of assets, the price of the wealth. So we have a capitalism that's dominated by wealth. And the macroeconomics is dominated, is a wealth-dominated macroeconomics. That was the comment. I'm sorry to I don't disagree with you, just wanted to add a different reading. But let me now comment and some of your points. And I enjoyed reading the papers, the 2 papers, and I think that I'm now going to read the second part of your book, because I had read first part and now I want to go and read it, and I enjoyed pretty much. So one comment is that in your description of the retain and reinvest model, I think the retain and reinvest model is all right. At the same time, you mentioned that labor, investment in qualifying labor, and particularly in learning processes for labor, are critical in the retain and reinvest. On the other hand, you do also recognize that innovation became more collective and more cumulative. So innovation now are more easily supported in a system if you have a well-organized collaborative ecosystem. So you need to have scientific basis, universities, laboratories that are capital intensive, provided by the state. You have also private R&D equipment and labs. You have relationships between these, and you tend to have more open in innovation. The information technology has facilitated scientists to communicate. So there is a lot of collaboration, global collaboration. Scientists are in favor of global science in terms of sharing knowledge. So the innovation process became more socialized in one side. On the other hand, they are private. They're subject to private appropriation. So I think we need to think in a different way on how to move the innovation process towards public interest goals, how to drive the ecosystems towards public interest goals. And this became more complex. So I wish to hear on you, so because it's not just the tools that we know, procurement, grants, incentives, how could we think of other tools, including changes in tax treatment for speculative capital gains, tax treatment for tax havens, how to tax the big monopolists of the IT services champions, how to induce them towards collaborative R&D, how to induce them to do something in favor of public interest. So this is the big issues. How to reward innovation or de-risk innovation, I think are questions that we should think about to propose a broader initiatives in this sense. I think the pandemics offer us this big opportunity to rethink where the public interest is, because the public health is a public good, obvious public good. So it gives us a concrete example on how to try to move policies towards public interest. And I think your examples of were very good. I enjoyed very much reading the examples of the respirators and other. We had something similar here in Brazil. And maybe the key is not just create, the essential thing is to create the capabilities within the health complex, but not just creating the capabilities, but creating the readiness to move and to address the challenges. So this is some of the provocations for you in having, I think I already extrapolated my time. So I stop here and I congratulate you for your very insightful and very exciting intellectual creation. Thank you.
Thank you very much, Professor Luciano, for your very interesting and provocative comments, and also about the macro foundations of the financialization process, which I think that complemented very well the exposition of Professor Lazonick. And then I will pass the word to Professor Lazonick to make his comments on the comments of Professor Luciano. And after that, I will pass the word to the audience to make any question, and asking everyone who wants to make a question to do it in 2 minutes maximum, because we don't have much time. So to give the opportunity for other people to ask questions too. Thank you.
Okay, yeah. Well, I think we're in quite close agreement on almost everything, and I think except that there's lots of connection dots to be connected, and I agree totally. The micro macro dimensions, but I think they're largely political dimensions, and you know, who has wealth and power in the economy and how they use that wealth and power makes a difference to the politics. And I like looking at the United States when you had a situation in the U.S. Before the Reagan Revolution, but it was where you had, even in 1980, the highest marginal tax rate was 70%, and of course it had been as high as 91%, even 92% shortly, briefly, on personal incomes. It was not the result of the New Deal. This was actually the result of the corporate elite and the you know, the lawmakers recognizing that it was still an economy where most people didn't have a lot of savings. They were buying their homes, they were buying their cars for the first time, et cetera, post World War II, so that they had to have some source of money, and they didn't yet have the Japanese with all that money that they could lend them, or and the Europeans couldn't either at that time, of course. So at least from the U.S. point of view, there was a consensus over certain things that came from an elite that now people look back, you know, they look at the Eisenhower era and they say it was almost like socialism, you know, and it was in a way, but it was actually, particularly when you look at corporations, it was done in a context where it was mainly white men who got these privileges. So the book we've written on Black employment, what's happened to Black employment, it wasn't the purpose of it, but it's quite clear to me, having done that if coming into the 1980s, these blue-collar middle-class jobs that were being competed away, I mean, the Japanese were competing them away, there was later automation came. If that had still been just a white man's world in the United States, they would have put lots of money into education. They would have upgraded the labor force. So I think a lot of the reason they didn't do it because of racism. But the other reason they didn't do it was because of globalization. In fact, those companies you mentioned, these, you know, I think it'd be the FANGs or the FAMs or whatever they're calling them. They would not be able to do what they were doing without Asian labor in the United States. And we have in our book, we haven't put it online yet, this part where we got access to some of the data on, you know, who are the professionals in these companies, the particular companies. You know, Asians are about 6%, 6.5% of the US population. They're about 45% of the professionals in those companies. And Blacks and Hispanics are not hardly represented at all. So basically what happened, and through immigration policy, and so this doesn't just happen. There was actually immigration policy that started in 1965, but really in 1990, pushed by high tech to say, let's get another labor supply. And at that point, you didn't have to worry about, are you going to upgrade the labor force in educational labor force in the United States? And so in fact, they did things that don't make any sense. Like, you know, and you can talk about different countries because each country is different. But in the United States, at the time when there's a knowledge revolution going on, and you need all these high-tech people in the 80s, they are making public higher education more expensive. They're making government student loans extortionate interest rates. There's all kinds of things that you would not do if you wanted to have public policies to actually build the capability of the labor force. And then partly they didn't have to do it because the United States was getting a free ride from a highly well-educated labor force. And of course, the secret to the East Asian development was ultimately that the East Asian countries, and they did it in different ways, and of course, much more unevenly in India, but that they educated the labor force even before they had the demand for that labor. And so there was a brain drain, you know, and US got a lot of the advantage of that in the 60s and 70s. And that's actually one of the things that opened the door to immigration, which had been shut largely to Asians. So there are changes that are made in terms of interesting that I think there is something a lot to be written on the difference between this crisis and the financial crisis of the 2008-2009. Because first of all, basically, that of course the crisis was created by something that no one would have expected then, and that is that lending money to people who couldn't afford homes could almost bring the world financial system to its knees. But actually, and mainly in the United States, and through a bunch of practices where you just rising value of houses, you had all these subprime mortgages and then repackaged them. And of course, once that happened and once it was exposed, the government policy, the stimulus and the so-called stimulus and the Federal Reserve had to come in and bail out the banks. The banks aren't actually being bailed out now. They're losing money, but they're not in crisis. They're just losing money because there's no money on loans. Insofar as they're making money, it's by being involved in asset management or whatever. But they're bailing out the stock market. I mean, all this money is going in to just prop up the stock market, and then you have these. You actually find that there's a few companies that are dominant in that. And one of the points that I was making about the problem of change, because once you say that, okay, the micro to macro is ultimately people at the micro level have a lot of power and control over money, and how do they want to shape the macro policies? Al Gore and Bill Gates have nothing to say about maximizing shareholder value. They are the biggest looters in the history of capitalism, of their own companies, of companies that in Bill Gates' case built up and knows that shareholders never played a role in that. And if Al Gore doesn't know that, then he shouldn't be talking even about climate change, because he doesn't know fundamental things about what's underlying part of the inability to deal with these issues. So and so the more I look at this and the more I've seen the change, I mean, I'll just give you one example. When I was at Harvard Business School in the mid-1980s, I was working with Chandler, and I was a kind of insider, outsider there, the same at INSEAD. I was wasn't teaching, but I could see what these people were doing. Most of those people in business schools do not believe that crap. They do not teach that crap. If they're doing organizational behavior or strategy, they don't believe in all that finance, but they don't understand it. They don't have the slight, and a lot of this is because people like Stiglitz and people like Krugman, they don't understand it. They have nothing to say about it because they don't understand the firm. So whatever their policies are, they're going to just tweak those policies when, in fact, the reality is that, as the case now, the Federal Reserve, and this would be true even if it was Democrats in power, they would be supporting the stock market. They would be being pushed to support the stock market because it's not just right-wing people who are getting them. So the politics of this is very important, and how it changes at a certain point in time. And going back to the time when you had more stability, there, at least from the point of view of the United States. I mean, I'm not from the United States originally, so I kind of look at it as I'm from Canada. And I came to the United States exactly 50 years ago to study at Harvard because I wanted to go to I had been studying in Canada and Europe, and I said, well, you got to go to the belly of the beast. And the beast looked a lot worse now than it did then, because comparatively then, actually, even the economists in the Harvard Economics Department were so heads and shoulders above the people you have now, in terms of at least being willing to address some of, at least discuss some of these issues. But there was a much more of a consensus of a need for stability, and then the stability for various reasons, came apart. I mean, Bretton Woods, I think, had to come apart because you couldn't have the U.S. be the one to hold it together once you had the recovery, and particularly with the rise of Japan and just the exchange rates, and they couldn't be sustained, uneven development. But once it happened, the question is how do you adjust it? One other comment I'll make is that I think Japan is another case of the old capitalism still, okay? so that when you have enough social solidarity and enough of a sense of public purpose, you sustain the old system. So it has been sustained. The only problem is there's a lot of things you don't like about this system. For one thing, it's probably among the advanced countries, probably the worst place for women in the world. It's a place that doesn't have to deal with racism except against Koreans, actually, because it doesn't allow anybody in. It can deal with automation because it's educating everybody, and it has a very declining rate of population growth. But the Japanese actually were able, much more, let's say, than the Koreans, to keep out the predators. Now, what was the difference is that Japan, when they became a rich country, was not in debt to anybody globally, very unlike Korea. Korea had to kowtow to, the Washington Consensus in 1997. Japan did not. They had not suppressed wages. They had actually brought the whole country along in a context before they became very rich, and so there was already an integration of people at all levels, particularly, again, male rather than female, into these organizations. And South Korea is interesting because it was somewhat different, but it was subject to it was much more export oriented right from the beginning, much, big companies, and much more in debt globally. And when the financial crisis came in 1997, they had to adjust to that. And I think that's actually one of the conflicts going on in South Korea now, is the Chaebol are still a force largely for stability, but the government, and there's always big problems, of course, democracy when you have that much power in a few companies, but the government is actually been in many ways the worst enemies of the Chaebol. I should say that one of the things that led us to get into writing this book with Jang Suk Shin, who I've known for a long time, but he had been a journalist in Korea for a long time before, even while he was getting a PhD at Cambridge, and he had some close ties to Samsung. And I actually acknowledge in the book that some of this got some funding from the Korea Economic Research Institute, which is unusual funding for me because it's a private institute, and but there was no strings attached, and it's industry research organization or lobbying organization. But what actually happened, why they gave us the money, was Samsung was attacked by Paul Singer, Elliott Management, same guy who attacked, of course, Argentina, and is one of the biggest vultures around the world of these hedge funds. That was in 2015. Kim, the younger Kim, who is now the titular head of Samsung, gave some money to the former president, who's now in jail, to try to allow them to do a merger within Samsung, which would give them a larger part shareholding from 4% to 30% of the part of Samsung that Singer was attacking, and wanting them to do buybacks and disgorge the cash flow, etc. So this money was given. It was discovered when they did the government did the corruption investigation of the former president, and then the head of Samsung was thrown in jail for over a year because of that. And it was actually, he was thrown in jail because he was attacked by largely because he was attacked by an American hedge fund. So these things have lots of implications on how the stability of these systems work. I think is being very much result of the politics. And the other thing is that not all the companies that there's some of them that are doing extremely well that are of these new economy companies, these tech companies. But one we are finishing with my colleague Murray Carpenter, we've been working on for a long time, and hopefully we'll finish the next few months. We've got lots of other things to do, but we work on it. It's a paper called "Why Isn't Cisco Huawei?" So Cisco Systems, which is a world leader in enterprise networking, should be Huawei. It should have moved into 5G. It should have moved into, and it helped destroy companies like Lucent and Nortel indirectly by them trying to adopt the Cisco model. They started doing buybacks, and they didn't make the kind of investments you would need to make to produce carrier class equipment. Huawei, on the other hand, is not on the stock market. It's not controlled by the government any more than any big company is connected to its own government. But it's had what they call employee ownership. It's not quite, but they in the United States, when they were attracting people from secure employment with stock options, in China they were attracting people from secure employment in the government. Huawei did this by having employee ownership. So Huawei is a retain and reinvest company, and it's in a remarkably short period of time become one of the most advanced technology companies in the world. I would say certainly in that sphere, one of the most complicated areas it is, and that's why it's a leader. It has, and of course now its future is in question because of the Trump's policy, but that's politics, So yeah, I guess one last point to make is that each of these companies actually, we find this is why we go back to the micro. We had to know something about each of these companies to really know where they're situated in this spectrum of innovation, financialization. I would say Alphabet is still pretty much an innovative company. Facebook and Alphabet have an advantage that they have dual class shares, so the founders can never be touched and they in fact adopted dual class shares because of the rising power of hedge fund activists, which became apparent around the mid 2000s. Bezos does not have dual class shares in Amazon, but he had managed to maintain control and probably could not be pushed out. He only has he's one of the richest people in the world with about less than 2% of the shares now. Anyway, there's lots to be discussed on these things.
Thank you, Professor Lazonick. I will now open to the questions of the audience. I know that Marcelo we have 2 questions in the chat that I will read after, but I know that Marcelo wants to ask a question. I also want to ask one question, but I will wait. So I think Marcelo can ask his question, and if someone else wants to ask a question to Professor Lazonick, please tell me, please write in the chat.
Okay, you hear me?
Yes.
Thank you very much, Professor, for the presentation, for having the opportunity to hear you once again. The last time was in Brazil in live. My question is the following. How do advanced manufacturing or industry 4.0 and surveillance capitalism discourses and strategies fit into that broad picture of capitalism? Might it help enterprises to further decouple from some kind of social role they might have in jobs and income generation, sharpening a kind of jobless growth and maximizing value extraction for the financial market on several fronts, like shareholder value extraction at firm level, financing consumption for jobless people, speculating on those debts via derivatives, and financing conflicts derived from human deprivation. So in this perspective, is there a reformist way out of that trajectory?
Yeah, I mean, it's a difficult question. I think that in part, there has to be, Luciano mentioned the scientists. and the knowledge, the people who really have knowledge of these things. And you see this now coming out, of course, in the United States with the, of course, the kind of total disregard of science by the Trump administration, but people speaking up. But I think on all these issues, just as many have done on issues of climate change for a long time, you have to have the people who really understand what's going on and get them involved actually politically so that they have a political influence. Again, which I come back to, then you have people who are the disseminators of this stuff, like an Al Gore, that disgust me. He's sitting at one of the most successful companies ever and giving away $360 billion to people who are just causing more inequality and get bigger war chests to go after other companies. So, so there's these two sides to it. So, and I think, also the point about that is that if you don't see that this stuff is being done for the public interest, then nothing will change. And so you have to, I think there's a real weakness of this notion of what I say private enterprise, that this, shareholder value, that these companies belong to shareholders. So even very smart people will look at these companies and say, well, they have to do this for the investors. They'll say this about a pharmaceutical company like Merck or Pfizer. The investors are gone like 100 years ago. They're not there. They're just people who buy and sell shares. How stupid can you be? You can go and buy and sell shares. They're not putting a penny into them. The investors are the people working for the company who generated a successful product, and the government agencies that did this, that should be getting their money to reinvest in this, and the households themselves who funded this. So if people don't have this, I'm talking about this as an economist, and I see economists there, saying very, very stupid things. And I said I was on a talk with some people this morning. The worst thing, there's one thing worse than stupid people saying stupid things. It's smart people saying stupid things. and economists are all the time, they're teaching that the most unproductive firm is the foundation of the most efficient economy. That's what Paul Samuelson got a Nobel Prize for. So on these issues, that's where the power is. That's where the money is. That's what the people doing the surveillance. Now, there should have been, when they had the Telecommunications Act in 1996 in the United States, it had only been 3 years before that the government gave business the internet. Business did not know enough to invest in the internet, it gave them, and yet they said now anybody can do with it whatever you want, and there's going to be no regulation on how you make money off of this. You can just call that a big mistake, but it was also a logic of the rise of this shareholder-oriented new economy. And one of the points I make about this is that there's two sides to this. And this is actually one of the problems I think that scientists have. I know Helena told me that this movie, which I just watched, The Social Dilemma, is popular in Brazil, but you get it there. That some of these people who are engineers, scientists in these companies are saying, well, I didn't realize what a monster we were creating. But that's where you're going to get the creative jobs. So those companies that are the most financialized are the ones that have been most creative. And that's actually the crime about it, is that it's not simply that they're taking money from companies where you have all that capability. And one of the uncharted crime, and these people should be rising up like their own Black Lives Matter movement, and that is scientists and engineers in their 50s and 60s who have been thrown out of work and can't pursue their careers and are extremely valuable, totally the other end of the spectrum in terms of their life experience. But they are just, and we don't even know who those people are, but they're all out there. People who when the company says, okay, we don't need you, we don't want to move into more sophisticated products, we don't want to use your capabilities. They just lay those people off, and those people, not only a problem for them, but the huge investment, not just made individually, but by society, in capabilities that we need. So, I see that, there's different audiences here, but I think those people are a big audience, and they do not, when they talk to economists, even progressive economists, they're not understanding, in my view, where this problem, how deeply this problem of financialization of the corporation affects financialization of the whole economy, and then the goal, the way in which when you have a problem, things are structured or not structured. I think if you had less financialized companies, they would have donated 1 million scientists and engineers to dealing with the COVID crisis in the United States. They would have, there's things that can do despite Trump that they could have done, getting together and say, that guy's a crazy idiot, but we can do something because we have a lot of money and power, and they're not doing it, or they're doing it in a really inconsequential way. So I don't know if that answers your question, but that's
Thank you, Professor Lazonick. Manolo wants to ask a question. And I think we can collect 2 or 3 questions, and then Professor Lazonick can answer them together. Okay? Manolo.
Well, thank you very much, Marina, Professor Lazonick, and Luciano. Really interesting, the presentation. We follow your work, and we all agree in the idea of that we need a more innovative enterprise. My question goes in line with this micro point of view about the discussion, and in some sense, I think that perhaps when you think in an innovative firm, you are thinking in the 4D firm. And in some sense, this film was a specific film that was in the Cold War. It was the 30 glorious years of the United States economy. And nowadays we are in a different geopolitical and in terms of work organization situation. In which sense do you think that our or this point that we are making is not specific determinate to a historical moment that were these 30 years, and sometimes our the critic is much more a moral critic than a real a critic to the capitalism as we know today. This is one issue, and the second one is related in the same way with respect to macro. When you talk about fictitious capital, at the end of the day, the last adjustment is the effective demand, and these companies they are selling their products. So, in which sense is this fictitious capital so fictitious? Because at the end of the day, they are selling some products or services. So how do you integrate the effective demand with this micro view? So these are my 2 main questions.
Thank you, Manolo. Does anybody else want to ask a question to Professor Lazonick? So I will ask one question. One of the implications of your ideas is that the innovativeness of the firms is being reduced by these financial strategies. I would like to hear from you about the implications of this process to the innovation policy. In other words, what the governments should do to avoid that the incentives and the money put to stimulate innovation in the different countries does not go to the financial circuit. which new instruments, which new measures should be taken by the governments in the industrial and innovation policy. Thank you.
Okay. All right. Good question. So first of all, on the notion of the old economy business model, which I think you call Fordism, which I don't like that term Fordism because it doesn't really describe what anything that ever happened in the U.S. I mean, Ford Motor Company almost went bankrupt in the 1920s, which was the period when you really had the rise and the consolidation of large corporation. And even without unions, you started getting workers getting higher pay and more job stability. But I would not, I don't see us going back to that old system of a career with one company, and which was also manifested by defined benefit pension plans were based on years of service, at least in the United States. They were not portable, and then that got extended to the government sector as well, and still is to some extent there, although it's under pressure because the business sector no longer uses those things. So there is a need, however, for what I call, because innovation is collective and cumulative, and it's embodied in people being involved in these processes, you need what I've been calling collective and cumulative careers. That is, people need to have the opportunity to have this job experience that in fact makes them productive and puts them in contact and allows them to make a living doing the things that they want to do and learn how to do them better. So that's actually, in terms of innovation policy, I mean, to answer both questions in one way, is where government is very important, and also where you have the households who are generating the people that can take advantage of these opportunities, because it used to be that you could get a middle-class income by working for a company that was successful if you had a high school education. That's not possible anymore, at least in the United States. It's not possible. You just cannot do it. There's too much global competition. There's too much automation. There's too much globalization. But so you have to increase the capabilities of the labor force. That isn't just education, which is one of the criticisms I have of this skill bias technical change. They just almost totally ignore 40 years, the importance of 10, 20, 30, 40 years of work experience in this. But it's going to have to be with different organizations. So there has to be policies that say you have to figure out how to build and protect this and utilize this knowledge base. That this and that's going to then be related to purposes. And I think we'll see where we come out of. I mean, this pandemic has certainly made people much more aware of something that they knew was a threat, whereas some people knew it was a threat, but it was not on people's minds the same way that climate change was. But it's quite clear that you need a global response, you need a collective response, you have to have people who are devoted to dealing with these issues and are going to earn a living doing this, develop the expertise over time, see the process as it's changing over time, have the power to educate other people. So that is the future, and that's not going to happen with one company, and it shouldn't happen with one company, because the dark side of that, which was true during the Cold War as well, is that you had a tremendous power in one company, and they could use it in ways that were not necessarily for the social good. So I wouldn't want to idealize those old companies, other than they were allowing in certain places and certain times, not just in the United States, but other countries, to have a certain amount of employment stability, upward mobility, somewhat more equal distribution of income. So that model that I've been laying out, I think it has to become, that's why I was stressing government business collaborations, and part of what I've been calling the investment triad, which then they say, how do these households, governments, and and businesses. How do the firms, the agencies, and government, and the units of households, of millions and millions of them, interact to actually have the capabilities to deal with these issues? Then you have to have the funding of those issues. But you're going to get the funding of these issues if you have a whole population that says we have to deal with these issues. And it's the point I was making about Milton Friedman. You know, to say that you don't need safer or more fuel efficient cars, I mean, it's a stupid thing to say when he said it, but you could say, okay, that's corporate social responsibility, because most people don't care whether they have safer or more fuel efficient cars. It turns out that most people do care, or a lot of people do care. And I mean, General Motors kept trying to find those people in the Midwest of the United States, or there's still the people who refuse to wear masks and vote for Donald Trump, who didn't care, who still wanted to buy the big gas guzzling, you know, pickup trucks, you know. So there's, you know, so in fact, and that has to do with, you know, the education of households, you know, they have effective demand. I think it's overstated, because where's Nokia and BlackBerry in the smartphone market? No lack of effective demand. They weren't able to compete. By the way, they weren't able to compete because they became financialized. It's not the only thing, because Sony and Ericsson wasn't able to compete, and it wasn't because of financialization. It was because we were trying to take Swedes and Japanese and get them to work together. It didn't work very well. But in general terms, you're going to have effective demand if you have people who have good jobs and upward mobility and more to spend. And then, of course, it's demand for what? It used to be there was much more demand for cigarettes until the scientists convinced people that they could kill you, and then you got, even in the United States, legislation which says, you know, cigarettes kills, that you had to put on the packages. And all of a sudden, what was seen as advertised as a high quality product, this would make, you know, a lifestyle product, the Marlboro Man, or they used to have, when the women's movement, you come a long way, baby. It was at Virginia Slims. It was cigarettes for the new woman, you know, Gloria Steinem woman. That all of a sudden disappeared. Because there was a different understanding of what was good for people and what was not good for people. I mean, I remember in the early 90s, having a big argument on, I think it was SAS Airlines, because they had 2 rows in the back where there were no smoking. And I, you know, I'm going to be subject to this. And they thought I was crazy. You know, like, what right do you have this? And within a couple of years, no airline would allow, you know, so things do change this way. I mean, we're talking about even much bigger changes. But so I think you have to mobilize the people to, you know, you're going to get the products that the society deserves, and the companies producing those products, and the careers that you know, that are allowed to flourish, to allow them to work. I think there's the question about yeah, and so in terms of public policy, I mean, I really see it as you know, once you make the commitment to those careers, the commitment means nothing if there isn't money there. And again, it has been done. I mean, the United States, the land grant colleges, free higher education, GI Bill. I mean, a whole bunch of things that you can find this in other countries in different ways. And it's not there now, but it was there when there was a commitment to build up the labor force. Again, I think it was largely because it was not seen as being a brown or black labor force, it was just seen as being a white labor force. And I think attitudes, whether people realize it or not, really changed about at that. And the Reagan Revolution was a lot about that. It's not the government. You didn't want government, but who was going to get the benefits of government? That changed. And so I think the social movements now have a big chance to change that. I have a problem with maybe as a short-term solution, guaranteed basic income, or certainly I have a problem with modern monetary theory and printing money because they're just not dealing with productivity. And so I think the question is always, if you're going to sustain this, how are you going to be productive? So I've stopped teaching now, but when I was teaching an introductory economics course a few years ago, first question I would ask the students, they were from mostly working class backgrounds, be sitting there. They never did quite understand what I was talking about, but never mind. But right at the beginning, I asked them one question. I said, how many people here have had a job that paid you money? And they almost all put up their hand. Everybody put their hand. And I said, okay, my question that you to think about in this course, and it's not meant as an insult to any of you or anything like that, but why would anybody pay you to do anything? And, I think that's the question we have to ask is what makes labor valuable? And it's obviously it has to do with, politics. It has to do with social purpose. And so I think the movements are there, but the movements have to now get the power to structure the institutions. And so, and I think if you do that, then you're going to get innovation, but you're going to get innovation also that is not Cold War innovation, that is innovation that's good for people, etc. And so ultimately, I think it does come down to social movements and those social movements that are saying that there is knowledge that we can use to solve society's problems. People shouldn't be allowed to get super rich out of that knowledge. They should be happy the way I think most of the people who are sitting here watching are, to have jobs if you have them, and to be able to do creative work, which I think most people, and one of the problems, like I'm studying the pharmaceutical industry, I mean, in the United States was, as you probably know, the Bayh-Dole Act of 1980 said you could use federally funded research to set up businesses. And right away, that then created a certain greed among scientists that was really destructive of sharing of knowledge, which fed into, gave them an opportunity. And some, you can see this in the pharmaceutical companies now. So you got to get rid of that. It's not there inherently, but the way things are structured now create way too much scope for greed, and because as I say, greed is good, and even the progressive economists don't have anything to say about it. I mean, one of the comments I've always made about Bernie Sanders, I'll just stop after this, is he's always going on in the United States, it's great, talking about, the billionaires are rigging the political system, but I've never heard him talk about how the billionaires get their money. And there's no critique coming out of his, and I know a lot of the people, out of his group of people, including the economists, of how billionaires are making the money and how they have a stake in the system. Or the type of critique that Matt and I make in this paper, that we have some billionaires who should be the good billionaires who are actually the bad billionaires. I mean, the ones who are speaking for public purpose, but then in their companies that they control, do things that are actually driving us into this, creating all kinds of inequality and instability and actually losing leadership even in technology. So.
Okay, thank you again for your answers. There is one question by Marina Marcato, that is a professor from the Institute of Economics of the Federal University of Rio de Janeiro, is a colleague of us. She asked, bear in mind Penrose's idea in her following statement, growth by definition implies that the firm takes unto itself the activities associated with the opportunities for production and marketing that it perceives in its own capabilities and in its environment. Would you say that there is a progressive departure between productive and innovative capabilities and the internal determinants of the firm's growth setting the scene of secular stagnation? That's Maria's question.
Well, so you mean a secular stagnation that it doesn't take up the new opportunities? I'm not sure how the secular stagnation comes in.
I'm sorry, I also don't know.
Yeah, but I would say, I mean, I think firms can grow too big. I think, you know, if I was running Apple, I would have said, okay, here are all these people. I mean, there's a lot of different things. You can read the thing I wrote 6 years ago that Tim Cook has never responded to, but nevertheless, there's different things that could do, such as pay the people in the Apple stores better and give them careers. But that company and other companies like it could have, and Microsoft, they could have taken that money and they could have taken the people in that company who wanted to do more creative things, had some new ideas, and you don't need to do them in the company. You spin off another company, and it's not an unusual thing, but it's giving up direct control. But it's saying it's also creating incentives for people to work within the company. That this company will, when it gets, you know, if they have some entrepreneurial idea, they'll spin it off. And the company itself, as a unit of strategic control, doesn't get bigger and bigger, because there is a problem of strategic control once it becomes too removed from the learning processes. And frankly, I mean, I think one problem that Apple has is that Tim Cook is the guy. He's a supply chain guy. What he did for Steve Jobs was he told them how Apple didn't have to do their manufacturing. So he has set up the contract with Foxconn and outsourced their production. Now that was very important for Apple's growth, and I don't think it was necessarily the wrong thing to do at all, because it helped to foster development in China, and Foxconn went from nothing to be one of the world's leading companies to contract manufacturing in the world. But the guy who does that should not become the head of a company that has all kinds of capabilities that it can use for technology of the future. I don't care. He's just not going to understand it. We see the same thing with Cisco. So the guy who was the CEO of Cisco, John Chambers, for 20 years, Cisco was growing with this new opportunity because of the opening up of the internet. It had an advantage over other companies that were doing internetworking, because that company, coming out of Stanford, and for various reasons, they had written software for all the different protocols as they were ready when the internet protocol became dominant. But then the way they grew very quickly is by not doing direct selling, by using what they call value-added resellers. And that has become a bigger and bigger part of their way they're selling. So in many ways, they also didn't do manufacturing. So it's very hard to be innovative in more sophisticated technologies if you're not doing the manufacturing, at least at the beginning, and if you're not doing direct contact with your customers and learning from your customers what they need. So Cisco was kind of structurally, as it came into the 2000s, and had all this, you know, had money and had the capability and could have hired anybody it wanted. It had a structure and top executive who reflected that structure, who were in many ways incapable of leading in a new direction. Now, does that mean it couldn't have gone in a new direction? Well, it could have if they had then say, okay, it's a new era, and replace that kind. He built up the company in that way. We now have to go in a new direction. But instead they went in the financialized direction. And everybody loved that, because Cisco since then has bought back 100%, over 100% of its stock. Ralph Nader then got a little upset because he had bought Cisco stock at its peak in 2000 and they weren't paying dividends, so he pushed them to do dividends. So that was kind of ironic. So now they also pay dividends, but which aren't as bad. But yeah, even who's running these companies, I say, is being of critical importance, and then how they, how they get rewarded, or how they don't get rewarded is and how they're supported by the system, or even what they're willing to think about. But I mean, doing the work that I do, I mean, Fortunately, it's had some impact because Harvard Business Review, for some reason, published an article which looked like it should have appeared in, the title should have appeared in a radical economics journal. And it got a lot of attention. And actually some politicians, congressional politicians are paying close attention to it. But generally, there are virtually no business people who have talked out against this system. They just don't. They just keep their mouths shut. They don't even know what they're thinking. I mean, there's hundreds of billions of dollars back to the buybacks. They do that without justifying that in any way. How is that possible? Like with dividends, you can say, okay, you got people who are getting their incomes from dividends, and they're shareholder. You have to hold the shares to get dividends. Buybacks, you make the money by selling the shares, including the top executive. So there's a back to this issue. There's a real kind of problem of people who should know better not knowing better. Smart people doing stupid things.
Okay, thank you very much. I don't know, is there anybody else who wants to ask a question? Cassiolato, please. You should open your microphone, please. It's not opened. It's not open, Yar.
Okay, now I think it's open. Yeah. Thank you. Okay, Bill, again, thanks so much for your very exciting and powerful presentation. You raised so many questions. The discussion has been very good. Actually, I'm really looking forward to your coming Cisco Hawaii paper, particularly after what you just said. Please send us a copy as soon as it is out, because it will help us a lot. I would like to have a very simple question that has to do with the relation between governments and firms and large firms, in particular in terms of industrial and innovation policies. We have several students of the PhD course that I and Marina give, which is about industrial and technology policies. And I think that this perhaps can help them a lot. One of the very important examples of your recent paper, the ventilator example, and with BARDA of government and corporations, and you showed in your presentation and in the paper, well, the very limits of some traditional policy measures, such as procurement, when dealing with big corporations nowadays. Now, we all know the importance of procurement in the history of the United States, more than 100 years old history of having procurement as a big instrument of policy. Nowadays, part of it has been recalled by neoliberals as PPP, public-private partnership. And we know in Brazil that we can have some very good outcomes from very well-designed PPPs. With us, I think is still there, Professor Carlos Gadelha from the Fiocruz. He led a team in government almost 10 years ago, which designed and implemented a very useful, perhaps the only good PPP policy that we had in Brazil. I don't know if this would work at the same level nowadays. But PPPs became very widely used, and there are some, including some PPPs in the area of R&D and innovation, and the European Union has been using this. There's a program there called Innovative Medicines Initiative Joint Undertaking. It gave more than 2 billion euros to fund projects by supervision of industry, and the result has been very bad. I won't go into detail of that, but anyway, this is the point here is that procurement as a policy instrument, and the problems it has to be used with this type of large firms, using the example of ventilator that you gave. A related thing when you talk about procurement came, I was telling you at the beginning, when I downloaded yesterday the final report of U.S. House Committee on Transportation Infrastructure about the design, development, and certification of the 737 MAX aircraft by Boeing. And Boeing is, you wrote a very good paper last year in the American Prospect telling the story of this deal. The paper is called "Make Passengers Safer." Boeing just made shareholders richer. And your article shows precisely that during the critical 737 MAX design, development, and certification, Boeing spent $7.4 billion in stock dividends and $43 billion in stock buyouts, and at the same time decided to design the wrong airplane. They decided to re-engine an existing airplane rather than designing a new one, and choosing its 737 MAX project. You mentioned that your estimated cost of building a brand new airplane would be around $7-8 billion US, and Boeing spent around $3 billion in re-engineering, redesigning an old 737 with the problems that we have. The decision, as you mentioned, proved crucial to the failure and to the killing of hundreds of innocent people. But at the same time, if you look at Boeing figures in terms of R&D, they keep spending millions and millions of US dollars, and they keep receiving a lot of money by procurement from US government institutions. Well, then very briefly, the two questions related would be, do you think that the same type of problem that you found in the health industry with procurement can affect also the defense industry in the US? To what extent the maximizing shareholder value strategy are harming also defense type of innovation in the case of the US?
Yeah.
The other related question is that it's possible that to think that things may change when the government itself, and this comes from your research and other research that have been popping out in the last couple of years, and the government itself and policymaking in particular are so dominated by the financialized interest of large firms. This is not only in the US, you showed also in some European countries. And I came across a recent article that appeared in the Structural Change in Economic Dynamics. It's called Financialization Industrial Policies in Japan and Korea, Evolving Institutional Complementaries and Laws of State Capabilities. That argue that even in the case of Japan and Korea, this type of say submission by governments and by policymakers to the interests of large financialized corporation is harming, even in these countries that have the history of a development state, are harming their production and innovation performance and the impact of and possibilities of science and technology and innovation and industrial policies.
Mm-hmm. Okay. Yeah. Well, let me say, in what in part, well, you find is each case we have to look at because there is a question of the devil in the details. So, in the case, what we didn't when Matt and I started looking, which was only in March, end of March, beginning of April, at this ventilator question. We didn't know anything about ventilators. We just got interested because there had been these reports in the New York Times and a ProPublica investigative journalist outlet about the government having funded these ventilators, and then nothing was delivered when they needed them. Turned out that the amount of money that was put up out front was actually very little. It was about $20 million for the 2 contracts. We go through it in our paper. But well, the important thing is that this was more than procurement. And I wouldn't have known this until we started looking at the case. The government, first of all, the agency, was getting these ventilators very cheaply, way under price. And of course, they wanted them cheaply because they might never have to. They hoped they would never have to use them, and eventually they become obsolete. They had to be maintained. They had to. So the first contract was $3,000 per ventilator. The second one, $3,280. Easily 50% discount on. But it was more than that. It was for these companies to do innovation in ventilators, to actually get the same quality, to get them more mobile, to get them more use latest technologies, allow you to use less experienced people on some parts of the process of intubating people, etc. And so they were actually funding. This was not just saying we want to buy them. They could have just bought them from anybody. They were saying we're going to take this opportunity to fund innovation. Now, from the point of view of the company, what was, first, it was a very small company, never had more than 160 people. It was actually owned by the Japanese. But what their interest was that by getting the government contract, they got a little bit of upfront money, but more, and they got a guarantee of a certain amount of revenue. But the money was going to be made by having this innovative ventilator to sell on a much smaller quantities on the commercial market, of course, unless a pandemic comes and everybody wants them. That they could charge higher prices for that and be able to advertise the prestige as being the company that got the government contract. Because in this case, which is one, I mean, so that was the advantage. When Philips Respironics did it, we don't know all the details about why they did it, but a lot of it was because this underlying company, Respironics, was a highly innovative company, and they were doing already the innovation in ventilators, and so they thought, well, this can't hurt us to have this contract. They didn't need it as much. It was part of a company already that had a lot of money, Philips and nationalized, but they in the end now they haven't delivered any of them at that price to the government, but they have been selling them at a much higher price to the government. But so they're acting the way we would expect a financialized company to act. That's a Philips. But the thing is, it wasn't just procurement. It was a government business collaboration to do innovation for a particular purpose. Now, the problem in the Boeing case was, in many ways, they were too close to their customers, and part of the problem, at least the rationalization why they could do a re-engined plane back in 2011, they were put in a position. They knew that they would have to have another plane, and they knew the new engines were coming online. They knew there was all kinds of advancements in avionics materials. And they knew also, they should have known that they should have done a clean sheet replacement, a wholly new plane. Partly already, they were highly financialized. They were, it's well documented, they moved the headquarters of Boeing from Seattle to Chicago, so the top executives didn't have to be too close to the engineers, bothered by that stuff. And they, from the time in 1997, they merged with McDonnell Douglas, which actually brought a lot of financialization in. They were just thinking of getting their stock price up. So there's already a problem. But when they then had to come up with a plan, which they had been thinking about for years, for this new plane, they were forced to do it because Airbus came out with their new plane, and Airbus didn't have the same structural problem that Boeing had, which had to do with that the 737 had architecture from the 1960s when planes were built lower to the ground. And so they went ahead with this, and they rationalized it on the grounds that Southwest Airlines, which is a big airline in the United States, they only were buying 737s, and they didn't want to have the obligation to retrain their pilot. They wanted to be seen as the same series, which had certain costs. Now, the thing is, I have to read the report that's come out because we were thinking of writing a more academic article on, I mean, we wrote that other article, but we wrote it fairly quickly, and I think we got most of it right. We had to talk to a lot of people about, and fortunately my co-author, Erdem Sakinci, had done his PhD thesis at Bordeaux on 3 years earlier on comparing Airbus and Boeing. So we already knew a whole lot about the company. But in this particular case, it's quite clear that in 2011, when they had to make the decision, they knew that it was the wrong decision technologically. They knew that, you know, to get the fuel efficiency, they had to put a much larger engine under the wing, and it turned out they couldn't put it under the wing than was required. And even then, they kind of their engine is much smaller. They're both GE LEAP engines, much smaller than the engine that Airbus uses. I think 69 inches versus 78 inches, but they really went beyond what they should have done. And then part of I waiting to see if they have any of this information in the report. The question is, who was saying what when about you know, the problem as it was going along, and because we took a certain amount of come out about being warned about that these were being unsafe. But what is clear, once they went down this path, and top management tried to pretend that there was no safety problem, and if it had just been the one crash, and somehow they had gotten away with not having that set up, because there was, you know, it was 2 crashes out of, I forget how many, you know, millions of miles, but the plane had been around since 2017. This was 2009, late 2018, 2019. But if it had just been the one crash, they might have still be flying. But as second it was the 2 crashes, there were already people who looked at the first crash and said, "Hey, this is the same thing." And a few days later, it was grounded. And then all the investigations show that it should never have been built. But it's actually probably the most clear-cut case where they had the absolutely wrong incentives, and they reinforced that. I mean, one of the points we make is that less than 2 months after the first crash in Indonesia, they had been doing this. They were up to about 9 billion of buybacks per year. They probably would have gone the next year in 2019 to 12 billion. They were less than 2 months after the board authorized a new $20 billion buyback program, which just means they had the right to buy back that without asking the board in the future, and a 20% increase in their dividend. And they were the soaring stock. They, you know, what people are seeing now with Apple and Microsoft and Amazon. It was Boeing then. In late 2018, 2009, Boeing, this old company, was with the sale of this plane. Was their stock was it hit an all-time peak on March 1st when the new dividend came into place, and March 10th was the date of the second crash. You know, and so it couldn't be clearer that that, you know, management was not only not going to, you know, worry about this. They were going to double down on doing whatever it took to get their stock price up. And you know, and probably there's nothing they could have done in any case at that point, because other than recognizing after the first crash, we got to ground all these planes until we figure out, make sure another one doesn't crash. But they weren't willing to say that, and no one forced them to say that. You know.
Thank you again. Thank you very much for your detailed answer. I think it's getting late, and our guests are probably getting tired. And I don't know if someone else wants to make any point. If not, I would like to thank you, Professor Lazonick. Thanks, Professor Luciano Coutinho, the audience for being here for this very, very interesting and exciting seminar. And I hope we will see next week in the next webinar of RedeSist that we are going to diffuse the information the next days. Okay, Cassiolato, I don't know if you want to say a few more words.
Well, just again, thanks a lot, Bill. Thanks a lot, Luciano. Thanks a lot, all the friends that spent the last few hours with us. It has been a magnificent afternoon. It helped us a lot. And okay, let's keep moving in this world of pandemic. Next week we will have some discussion on China. And again, Bill, thanks a lot. It's been a pleasure.
Yeah.
Congratulations, and let's keep in touch. I'll certainly.
Yeah, definitely. Yeah,
very much.
No, it's great. Thanks for asking me, and it's glad to do it.
Thank you very much. Bye-bye.
Bye-bye, everybody.